where you are different. You're calm, you're calculated, you're patient, because you know that that given day, there should be some kind of opening imbalance, some kind of difference that's significant from the previous day's settlement price to 9:30's opening price. And to the degree of how much of an imbalance is created by that, you get intel, you get information that tells you more about how that daily candlestick is going to deliver. And you understand that if there is a opening price higher at 9:30 a.m. New York local time than that of the closing price at 4:14 p.m. Eastern Standard Time previous day, if it gaps open higher and it's a significant gap, you know that there is, in the first 30 minutes, statistical probability that's 70% over the last 40 years, that in the first 30 minutes, that your short-term bias should be bearish in that instance, trading down to half of whatever that gap is. Retail doesn't think that way. They don't go in anticipating something like that. Retail sees this. Well, we gapped open higher, so that means it's strong. Let's buy it. If you measure the relationship between where we closed the previous day, and this is something for you guys that like to make indicators in PineScript for TradingView, here's a challenge for you. Ready? Create an indicator that plots a cumulative line. Okay? And you want to plot it with measuring the rate of change between previous day's close to today's opening price. And you can start with a number like, I don't know, use a value like 10,000 or 100,000. And then today's opening price, how many ticks is it above previous settlement? How many handles is it or points above it? And you would add that many to that original starting value. And then every day, plus or minus, you're adding or subtracting to that. And it's creating this cumulative line. Eventually, what you'll start seeing is that's measuring the public's perspective, because they see, oh, we opened up higher than the previous day's close. That's bullish. And they will want to do what? It's higher. It's strong. Let's buy it. Buy. And that's why I told you on Friday, I'm not interested in being long. To the jokers that like to say I was looking for longs. I was not looking for longs. I was absolutely not looking for longs. I was looking for further protraction because it's non-farm payroll. It can deliver that and screw you over. Everybody now knows that if there's an opening gap higher, that's a premium gap. Inside that first 30 minutes, your bias is bearish. Always. You're never chasing that. You're never buying that. Never, ever, ever looking for longs like that, ever. That's somebody that doesn't listen. That's someone taking things out of context. That's someone that's a joker online. Don't take that as a compliment, because I'm not talking like a Heath Ledger joker. I'm talking about a grade A clown, a circus fucking animal. Okay. So when you measure the perspective by looking at where we opened today at 9:30 related to how we closed, the public's perspective is it's strong, it's going higher. Where the professional perspective is, what do we do from the opening price and how do we close that day? That's very telling, because what you can actually start doing is you can get a diametrically opposed measurement with a simple cumulative line. And by doing it on the open to close relationship, you end up with Larry Williams' accumulation distribution formula. But if you switch the logic and you do a cumulative line basis on the difference between previous close to opening of today, You're measuring the public's perspective. What do you think happens? Think now. What do you think happens when you plot both of those lines as an overlay, one over top of the other? And one fails to make higher highs when the other one does. And what happens when the public's perspective, which is the opening price related to previous day's close, is showing higher highs? When the measurement between the opening price to the closing price is saying, I'm not going up there like that. What do you think happens? That divergence is showing you an arm wrestling match between street money, stupid people, uninformed money, and the professionals in the marketplace. See, retail traders are not going in. Okay. Now, when I say retail traders, I'm not saying like the people like the YouTube streamers and whatnot, that everybody understands that there's a gap, and gaps tend to trade back into them, but not all the time. That's how I can tell you where there's a breakaway gap. They're not going to be able to tell you which one's going to be a breakaway gap. I have that logic. I can tell you which one's going to be a measuring gap. I can tell you which one's going to be an exhaustion gap. I can tell you where the fair value gaps are going to form before they form in your chart. That's logic that's not found in your books. But let's clarify something. When I say retail collectively are looking at that higher opening price at 9:30 relative to previous day's settlement price at 4:14, always New York local time. When they see that opening price higher, in their minds, immediately they're bullish. They're looking for some kind of continuation higher. Collectively. Now, inside of the retail classification of traders, there are individuals that know how to fade that opening gap. Some of them look for a full gap closure because that's what they think is going to happen. But not all gaps completely fill in. I'm teaching you that when you're bullish, you don't really want to see a full gap closure. And you don't find that in your books. You find them in all the people that study from me now on Amazon. That's a given now. But prior to 2016, when people were taking my leaked content and turning them into books and study guides and whatnot, nobody thought about just leaving a portion of the gap open and seeing that as bullish when it's gapped higher and trades down to half gap or 3/4 gap closure. Leaving something open, it indicates underlying strength, or in deference to when the market opens lower with a gap lower opening at 9:30, the public perceives that as extreme weakness and it means going to go lower. So their sentiment is immediately established as, let's get short. But the professional mindset, now let's be honest, okay? You're trading as a retail trader, but I'm training you to think unlike a retail trader. You have to trade as a retail trader in a retail brokerage account, but you're not thinking like every retail trader is. So you're thinking like smart money. You are a retail trader, but you're not thinking like a retail trader. You're not falling victim to the nonsense that these individuals subscribe to as the reasons for why price goes up and down. You're not doing that. You're not making those foolish assumptions over price. That because it looks like some kind of animal pattern, some kind of geographic pattern connecting the dots and trend lines, and therefore it makes some kind of a illustration, like a horoscope. You're looking at the real factors why price goes up and down. And if you can measure and compare the relationships on how, on a cumulative line basis, it's a very simple process. If the gap's higher at the open, however many handles or ticks it goes up and opens up from the previous settlement price, that's how much your indicator value adds to the cumulative line. And then you do the same thing by plotting the difference between the opening price to the closing price. And if you do that, what you'll start seeing is an X-ray view of real accumulation and distribution against the weak-handed public traders. And that's why when we look at these large opening gaps and the market has been building up, like I was describing on Friday in live stream. I said, I would never chase this buying it. I would never go long. I would never go long. I'm not interested in buying it. I don't care if it went up to the primary buy side. I'm not buying that because we already established a huge gap. And that's going to do what? It's going to entice retail traders to look for longs. I'm not looking for longs. I'm looking for the final Judas swing. And when we finally broke down, we started consolidating and created that little tiny little messy little range. I said, I'm going to cut through all this chaff right here, and I'm going to focus on this little fair value gap in here. Well, where was the gap? It was gap higher. So the bias is what? Bearish. It displaced lower. And I pointed right to that little fair value gap. I said, now that one, if all things being equal, and if this is weak, if it's bearish, it's going to stay in the lower half of that fair value gap and not trade in the upper half. And you watch that happen. And it trade down to mid gap and sell side. That's the professional perspective. Waiting for the indications that it's finally broke, it's shifted lower, wait for a premium array. And then when it performs, expect the upper half of it not to be traded to. And then the professional mindset is, we opened higher, that's a premium. Professionals sell short in premium. They don't buy. They don't buy. So when these jacklegs get on the internet and he posts shit, ICT was looking for longs. You're a fucking liar. You didn't listen to the live stream, and go back and watch it again. There's nothing bullish about me wanting to go long in anything I was describing on Friday. I'm looking to fade that. Always looking to fade that. I'm never going long inside of a Judas swing that opens up and starts trading higher. If it keeps going higher, it'll do so without me. That's not going long. But at the moment, exactly when it forms, I'll tell you, and then changes gears and goes lower. But they're going to ignore that. They're going to pretend that didn't exist. What live stream are they watching? That's what's funny. It's right there in front of them. It's recorded, documented. It's not ambiguous. But that separation between perspectives on how the public, the less informed street money, the dumb money, when they're expecting prices to go higher, at the very moment or time when professional traders, the perspective that I'm teaching to hold as smart money, when they see price at a premium like that and they open up at 9:30, we're anticipating a closure at least of half the gap with a 70% likelihood that's going to happen in the first 30 minutes. So they're romancing the uncertainty. Retail traders see that gap opening and they're thinking, wow, this is strength. My stock's higher than it closed yesterday. The index market, all these indices are opening higher than when they closed yesterday. The market's up. Let's turn on CNBC and let's hear them talk about how great it is. And you'll hear them talk about it. You never hear CNBC anchors say, oh, we gapped open higher, so it's probably going to start going lower, folks. That's not what they say. They give you all these descriptive terms. All these descriptive terms stating things like, oh, the market's really strong this morning. Market's really firm. So-and-so number of stocks are up, blah, blah, blah. What are they doing? They're leading you down the primrose lane. They're making you believe the bullshit that you're already feeling inside, the butterflies in your stomach that you think, I'm going to make so much money today being long. The market has gapped open higher, and they start romancing the uncertainty of how much more money they could make. Give me a second here. I'm not sure if you can hear my pups, but they're running around carrying on upstairs. Give me a second. It sounds like my son's already cuddling now. All right, so by having a diametrically opposed perspective than that of the less informed traders, the ones that place their religious belief and faith in things that are external to why price goes up and down, and focusing primarily on when the watering hole will lure the prey when they're not thinking they're going to be consumed and they think everything's safe. It's okay for me to go down there and get a drink at the watering hole. Everybody's drinking from the watering hole. This is where all the volatility is. This is where all the movement's going to take place. It's gapped open. This gap opens. It's strength. It's underlyingly bullish. I'm going to chase it because I feel like the market's bullish. And who knows how to time the market? So you might as well just go in and start buying it when it's proven itself being strong. And now contrast that with, oh, we gapped open higher. Let me measure how we are opened compared to where we settled yesterday at 414. Where's that midpoint? And you're anticipating that. You're not getting giddy. You don't have butterflies in your stomach when you look for that information. You're not all hopped up on goofballs, and you're not anxious and scared that it's going to fail that day. You're expecting the statistical probabilities to fall in favor like it has in the past. This is where it's most probably going to go. Now, that's not a guarantee, because a guarantee would be, well, just get short if it's gapped open higher. Don't even bother with a stop loss because you're going to be right. You wouldn't do that. But contrast that with the indicator following crowd that sees an opening gap higher and they want to be long. And because they don't know how far it could retrace, they just want to be long because they're afraid they're going to miss the move. They don't put a stop loss on because they romance the uncertainty. It's going to work out for them. Everything's going to work out for them this time. They may have lost money in the previous 20 trades and they're on the last leg of losing their account, failing their funded account combine, losing their funded account, losing the last bit of money in their live account. And they're going to ignore all caution. And they're just going to roll the dice because they're romancing the uncertainty of their profitability. And they're only looking at it with rose-colored glasses where it can only work in their favor. That's what they're telling themselves. They're lying to themselves. And you're not learning how to do that. You're learning how to look at the marketplace and say, well, the markets are likely to go all over the place any given day. You won't have any control over price. But I'm going to go in looking for this scenario. I'm going to look for this type of thing to form in price at this time of day. And I'm going to be looking for weak-handed traders to hold a opposing view to mine. And I will see that as advantage. I will see that as I am about to take prey. I'm about to eat. I'm about to fill my belly with less informed traders' equity. I'm about to consume someone's stop and use it as an entry mechanism. I'm about to take over someone's profitable trade. They will be neutralized and removed from it, and I will be properly positioned to capitalize on the profit run. That's what I train. I train predatory mindset. I'm teaching you how to be a carnivore, not just someone that can run fast and evade being stopped out and taking losses. I'm teaching you how to be the stop eater, the consumer of retail stops, the consumer of less informed traders' equity.